This is Elijah K. Johnson, and back with us today is our good friend Steve Penny from the Silver Chartist. Our affiliate link with him is silverchartistliberty.com. Steve, thank you so much for joining us today.
You bet, Elijah. Thanks for inviting me back. It's always fun to speak with you, especially on these live calls. Whenever we do these, it always seems to be very volatile market conditions. So it's good timing. And you'll have to excuse my mic. I'm not in my home office, as anyone watching can tell, but looking forward to a good conversation today.
Well, the audio sounds fantastic on your end, by the way. So thank you so much. And before I guess we can get into the charts definitely. And we saw a crazy week last week with gold hitting pretty much an all-time high, depending on who you ask. It kind of went to an all-time high. But your perspective first, if we could get to the big picture, because I think we're kind of caught up in the weeds right now with the war going on. There's this new COVID surge in China with some shutdowns that might impact US manufacturers. We're seeing inflation at a 40-year high, 7.9%. A lot of things are happening right now, but if we can kind of give a step back here, big picture for the next couple of years, what you see happening in the markets.
I think that's a great place to start today's conversation, because when emotions are running high in these times of heightened volatility, it's important to zoom out and take a look at the big picture, I think, number one. And number two, to remind yourself of your personal strategy if you have one. And if you don't have one, it's time to craft one, a personalized strategy. So zooming out to the big picture, I think it's important to think, where is all of this headed over the next few years? What's the end game here for the US dollar and other currencies? And it's important to remember we're headed to a point where there's really no solution to these problems we're seeing. There's just managed outcomes. And we see, national debt is north of $30 trillion now, and we're rapidly approaching a point in the coming years where 100% of federal tax receipts will go towards servicing just the interest on the debt. Now, of course, the system cannot go on that long, and of course, something will break beforehand, but we're converging on that point, and there's no solution to that problem. And then second, we're in the news, we've been hearing more about the petrodollar system, and just today we're seeing Saudi Arabia is trying to broker a meeting with China. And I guess Saudi Arabia and some other OPEC countries wouldn't take President Biden's phone call over the weekend. Now, to the casual observer, that may come off as just a side story. Oh, that's interesting, and move on to the next news piece. I view that as very significant, because the petrodollar system dates back to the 70s, is what's created so much demand globally for the US dollar. And the way it works is oil is sold in dollars, and then those dollars are recycled back into buy US treasuries, which suppress interest rates. And that gives us an exorbitant privilege as the global reserve currency holder. Well, I mean, if that system begins to even just slowly break down, it's going to accelerate the demise of the US dollar. I mean, that's not a political statement, but it's math. It's just where we are, and that's very likely to happen. And I think rather than pontificate about it, it's important to have a strategy and a plan for where this is all headed, and that helps you stay grounded in the volatility that we're inevitably going to see along the way.
And I think it's so important to look at those fundamentals, because what we're hearing right now with the, I guess you could say, devaluation of the dollar, people are calling it inflation, 7.9% right now. Some people say it's higher than that, but people are blaming that on supply chain issues, just the opening of the economy after COVID and all of that. But fundamentally, that has to do with the monetary system changing, yes. The money supply actually increasing so much over the last, I guess, really since the Fed was created, but, really since 2008, we've seen unprecedented money creation. So I think that that's definitely true. It's so important to look at the big picture, because we can kind of get caught up in thinking, these momentary things that are happening are the cause of this. But fundamentally, the cause of the inflation right now, it's not going to change if the supply chain issues get better, or if the economy just completely reopens. This is going to be a long-term issue.
Yeah, 100%. Last year, I think it was about a $2.8 trillion budget deficit, if I remember correctly. Don't quote me on that, but I'm pretty sure that's right. But regardless, we're on track for another close to $2 trillion deficit this year. So that means someone has to lend us that $2 trillion gap. And who's going to do that? If China's backing away, Saudi Arabia is backing away, and then the Fed is backing away, who's going to step in and lend us money to finance those deficits? It certainly isn't going to be, average retail investors at these artificially low interest rates. And to incentivize new demand for treasuries, interest rates would have to rise. Well, if interest rates rise, that collapses everything. So you can kind of see the dilemma we're in. Just knowing this big picture dynamic, there's no answer to this. You could sit across from a Harvard PhD economist and present these to them, and they're not going to have an answer because there is no solution. So it's incumbent upon us to have a plan and a strategy to weather what's coming down the pike or in the years ahead.
And for those just joining us, we're with Steve Penny of the Silver Chartist. Our affiliate link is silverchartistliberty.com. If we can now hone into the specifics and get to what actually happened last week and also what happened today, because we saw a sell-off in metals today after last week's a lot of volatility, I guess you could say. Gold hitting almost an all-time high, and silver breaking out as well. It seems like we're kind of back to where we started. So what do you make of the gold and silver markets? And we can start with the gold chart if you'd like.
Sure. And I like charts so much because they kind of take the emotion out of it. And you just said it feels like we're back to where we started, but we're actually not. I guess it depends where you measure from, but we're still well above where we were just a couple of weeks ago. And so why don't I go ahead and pull up some charts here and show you guys what the technicals look like. And we started with the big picture end game. And that's why I like charts. They can kind of help you navigate the course along the way, in the years ahead. So I'm going to start off here with a very big picture chart for gold. And your listeners have probably seen this chart many times, but it's a good reminder of where we are in the big picture. This goes back to 2011, and this is that big cup and handle pattern that everyone's been talking about. And, the kind of the resistance levels to watch are $2,000 and then $2,089. And although this feels like it's been a brutal sell-off, and it has, we're more than $100 off of the recent high, we're still above the key breakout levels. And when you go to a weekly chart, a little bit more of a zoomed in view, you can kind of see some of those big levels. So we broke out above this triangle pattern. I've heard people call it the Captain Obvious triangle pattern. And I think that's a good name for it because anyone who looks at technicals was watching that triangle. And once we broke out above it, the next objective was to make a higher high above 1880. Well, of course, we not only went above 1880, but above 1920 and 1960. So we were due for some backing and filling here. When you see these kind of nice rallies, we all want the price to just keep going up and up and up. That's what we want. And because we want to break free financially quicker, but that's actually, parabolic moves benefit the fewest number of retail participants. So to me, this pullback is welcome. And to be honest with you, I kind of hope it pulls back a little bit more. We've got the 200-day moving average down at about 1816. I would love to see it pull back that far. I'm not saying that's what I think is going to happen, but that would be very healthy. It would shake loose the momentum chasers. Any kind of war premium that was built in might be taken out, and we'd be back into more of a sustainable uptrend. And it would give us some nice trading opportunities and entry points if we pulled back just a little bit further. It's also important to note the bankers are they're shorting this rally, and the gold COT, it's not pretty. That doesn't mean we can't keep moving higher, but the commitment treasury support is kind of a fly in the ointment and suggests we might see just a little bit more pullback before the uptrend resumes.
And it's interesting that you mentioned how the bankers are actually shorting the rally. And you're saying that a pullback even to the low 1800 levels would actually be healthy for this rally.
Yeah, 100%. Because the definition of an uptrend is higher highs and higher lows, right? So the previous low was 1780. So as long as we carve out a higher low above 1780, that's an uptrend, and that's healthy. What we don't want to see is a lower low below 1780, because that could suggest, some more weakness, and this year and a half consolidation that we've been seeing could continue. But I think that's very unlikely at this point. I think we're going to make a higher low above 1780. And as long as that happens, I'm happy.
Now, when it does come to this cup and handle formation, what does that predict for the upside when we do get out of this consolidation phase?
Yeah, there's a couple ways you can measure it. If you do a measured move from the handle, which would be at 2089 here down to 1675, what's that? Just over $400. So you can add $400 to 2089, and that gives you, let's call it 2,500 for easy math. So that's one measured move target. Another way to do it is to kind of take the big cup part, and if you call it roughly 2,000 at the top and 1,000 at the bottom, you could add 1,000 to that 2089 and call it just over 3,000. I think both of those targets are going to get taken out in the fullness of time in the coming years, and I think we're going to go actually much higher than that. But those are two measured move targets.
Now, silver isn't making an all-time high yet, right? And it didn't definitely, but I think it definitely did break out of key resistance levels. Your perspective where silver is right now?
Yeah, I called this chart breakout slash backtest because you can see here on this chart, we had the silver squeeze downtrend channel that was in force for over a year, February 1st, 2021. And we finally broke above that. And now we're just simply pulling back to retest what was resistance is now support. Now, could we go a little bit lower? Sure, we could. The 200-day moving average is down, I think, around $24.20. So it wouldn't bother me at all to see a pullback towards the low 24s. But right now, so far, we're just pulling back to the initial support level. So nothing concerning here about silver yet, even though there is a little bit more downside risk. I am convinced the trend has changed in both silver and gold. And I'm looking for higher highs and higher lows going forward. And by the way, you mentioned silver hasn't made a new all-time high yet. If you go back throughout history, it's almost inevitably, usually, silver makes a new all-time high sometime within a year or two after gold does. And, silver obviously hasn't done that. It's still about half of where it was in 1980. So silver's due for a big catch-up move. And, I remain 100% convinced that's going to happen at some point.
I think, we talk about this so often, but the fact that if silver makes an all-time high, it's pretty much doubling from where it is today. Mm-hmm. If gold makes an all-time high, it's just, $100 or so from where it is today. So the upside in silver is just fantastic. It seems like the upside potential there. Now, when it comes to platinum as well, I know you're definitely very bullish on platinum. What has that been? What is the action you're seeing there in the last couple of weeks?
Yeah, platinum, looks very similar to silver. It broke out above that downtrend channel, and now we're simply back testing it. Platinum is just a few dollars above its 200-day moving average. Platinum is the one metal that could potentially outperform silver from my perspective. I'm not predicting that, but it's possible. Although I consider it much more speculative. So I own a lot more silver than I do platinum, but I do think platinum is worth considering to have just a portion of it in your portfolio. And, platinum's undervalued relative to almost every other commodity, and it's just breaking out. So I think this is a good time to consider scaling into some platinum for those with the proper risk tolerance.
Definitely. And if we could move now to the US dollar index, we cover this often because it kind of can explain a little bit of what we're seeing in the metals markets. Mm-hmm. Any big breakouts here or a weakness towards the downside that you're seeing?
No, the dollar's been in a strong uptrend. We broke out above this 94.65 resistance. That's now major support. And this 97.44 isn't accurate. I need to update that. We tapped just about 100 on the dollar index this past week. And it's been interesting to see the dollar rally in unison with the metals and also in unison with rising nominal rates. So what does that tell us? That tells us that there is a safe haven bid in here. And that's very likely, obviously, associated with what's going on in Eastern Europe, Ukraine, and Russia. When you see the dollar and gold rallying together, that's usually a fear trade. So when a little bit of that air comes out from the fear trade, I think the primary driver over the coming years for the metals is obviously going to be the monetary side of things. And, the dollar typically acts as a headwind or a tailwind, but they can rally together. So this is a good example of them rallying together.
Now, when it comes to what we saw last week, I think a lot of people were shocked actually at the moves we saw. I know we saw moves in gold, silver, nickel, oil was a big one that's impacting everybody. We're seeing good pullback actually today in oil. Your perspective on the volatility we've been seeing there?
Yeah, oil. So first of all, I have to admit when I'm wrong. So I've been pointing out for a few weeks before we last spoke this bearish rising wedge pattern in oil. And, I thought caution was warranted. Now I never deal. I always say I don't make predictions. I deal in probabilities, but I was looking lower in oil and we broke out above that. So I was wrong on the short term there, but you can see we broke up from, in the low 90s to $130 like that. That's a massive move. And now we're just back testing the $100 level as support. It's really hard to predict where we go over the short term in oil with these wild swings. We are at initial support here, but I think, over time, I'm very bullish on oil. Over the very short term, it could go either way. So really, I'm not seeing anything in the charts that gives me clear predictive power on where the price of oil might be going in the very short term.
Are there any price points that you say oil is a bargain right now?
Yeah, I don't have it in front of me on the daily chart, but we were in this rising uptrend channel. So I would love to see a pullback all the way to the lower rail of that previous uptrend channel. If memory serves me correctly, that's in the low 80s. Anything down there around $80 oil, I would view as a bargain. And I've got my shopping list ready.
Definitely. Now, the last, I guess, commodity you could say that you cover especially closely is uranium. What is the price action you've been seeing there lately?
Yeah, uranium has been very constructive price action. And it's been encouraging to see the uranium miners were down sharply from their November highs. They were down like 40+% from their mid-November 21 highs. But the metal itself held up really well, and it formed this very bullish triangle pattern above previous resistance, now support. And I've been saying, once we get a breakout above that triangle pattern, $50.80 becomes the next target. And then once you get through $50.80, I think 73 becomes the next intermediate target. And I do think that's coming. And there's a lot of money to be made in uranium miners between where we are now, just a little bit above 50 and $73 uranium. However, we've moved really far, really fast, not just in the spot price, but also in the mining stocks. So in our weekend newsletter, I was saying, hey, just a little bit of caution is warranted here in uranium. Not that I'm not bullish, but over the very short term here, let's buy pullbacks. If that's your strategy to buy pullbacks to support, let's trade our plan and plan our trades as opposed to chasing momentum.
Now, when it comes to what the Fed might do next week, if we can move back to that, the Fed is actually meeting this week, I should say, and they're expected to do a 25 basis point rate hike. Your perspective on how that might impact the markets, especially gold and silver, and do you think there are going to be any surprises that we see from the Fed this week?
Well, it's really hard to tell. So I'm going to avoid any predictions. However, I will say that leading up to previous rate hike cycles, what's typically happened is the metals sell off for the weeks and months ahead of the first rate hike. And then within a few days after that first rate hike, that usually marks a major bottom. We saw that in December 2015, also in the mid 2000s. And this time, I think that the metals began to anticipate that ahead of time, because we saw this rally begin before the Ukraine stuff really heated up. So it's going to be interesting to see. Another thought is often when you see really sharp moves ahead of an FOMC meeting or even a BLS jobs data, the first Friday of each month, you often get a fake out move before the meeting. So, we saw the sharp down price action today. If we see another sharp day down tomorrow, I would be looking for a reversal to the upside on the rate hike announcement. But as far as surprises, I think they're probably just going to do a 1/4 point rate hike, but anything is possible. So no real predictions on that.
And why does that happen? If you could explain for our viewers that actually gold often rallies on the rate hike.
Yeah, there's a phrase in trading. It's called buy the rumor, sell the news. So what happens is smart money, the institutions, the big money who drive these markets, they pretty much know what's going to happen in the news before it happens. So with anticipating rate hikes previously, what's happened is, the metals get sold off in anticipation of those rate hikes. And then by the time you get the actual rate hike, it's already priced in. So, there's no more downside. And then you just get a relief rally. That's typically what happens. This time it's going to be interesting because, we've been rallying and then we had this sharp sell off today. So it's really hard to make short-term forecasts. Elijah, I will say one thing on the Fed, because we're talking about inflation and all this. The latest inflation data is showing 7.9%. I think we all know that's, that's bogus, but let's just call it 7.9%. And let's say it even trends lower a little bit and we get down to 5% inflation this year or 4.5% even. I don't think that's going to happen, but let's just say that happens. Well, negative real interest rates are what fuels a gold market. It's the primary driver of a gold and silver bull market. So anyone who thinks we're going to get to 4.5 or 5% interest rates, nominal yields, no one thinks that. So negative real interest rates are baked in the cake, and that is nothing but a tailwind for the metals, despite any short-term volatility. So I don't think anyone thinks we're going to get ahead of the inflation curve. They might have thought that in 2021, but I don't think anyone's thinking that now.
Yeah, I mean, as you mentioned, even if inflation does go lower than it is today, I mean, we're at negative real interest rates, and that is the key for the price of metals. Most fundamentally, because if people can't get any money in this perceived to be safe to asset bonds, then they're going to move it to something else. And it seems like this is kind of the new normal. It seems like even the Fed is saying that it's not transitory inflation anymore. I guess if you could ask one question maybe to the chair of the Fed, what would it be this week? Because I mean, a lot of people are just saying the Fed is trapped. They can't prevent this inflation going forward.
Yeah. So before I ask the question, I would like to sneak a quick comment into them. So I'd say, Mr. Powell, we're at a $30 trillion national debt right now, and every 1% that you raise interest rates is going to add $3 billion in interest payments to the national debt. So if we normalize interest rates at 5%, that's going to add $1.5 trillion of interest payments on just over $4 trillion of tax receipts. How does that math work, and how do you normalize that? And of course, he wouldn't give a straightforward answer, but I would love the opportunity to ask that question and then press him on it and pin him on it. But of course, those questions aren't allowed to be asked.
Definitely. Well, Steve Penny, we really appreciate your time today, and looks like a very exciting time ahead. But it's really important, as we mentioned at the beginning, to keep focused also on the fundamental situation, because the events of the day aren't fundamentally most of the time going to be impacting things long term, and that's what we're all here for, is the long term. So your perspective, any last thoughts you had, and where can our viewers find you online if they're interested in learning more?
No, I think we covered a lot today, so always enjoyed these conversations. As far as finding more about it, we do a weekly report. We have a free version, and there's a unique link just for your listeners, and appreciate you mentioning the affiliation. I think there's a lot of synergy between your listeners and what we offer. So silverchartisliberty.com is the unique link to go check out to get the free report. And I will, without getting too in the weeds, I'll just say we've got some really exciting things coming for our premium members. We're doing a Silver Chartist app, which is going to be kind of a hybrid of Twitter, of Facebook, and normal blog membership website. And the reason for doing that is we want to create community in a safe place that's not, owned by Twitter or some third-party social media. It's going to be ours, and it's going to be uncensored, and where we can really connect with like-minded people and get to know each other and encourage each other as we're working towards our goals. So really exciting things coming down the pike.
Fantastic. Steve, once again, thank you so much for your time, and God bless.
You too, Elijah. Thanks.